This is Professor Hazara, and this is the second video on financial statement analysis ratios. We're using Pfizer as the example. In the first video, we went over the inputs to some of the ratios, and we're using a worksheet, an Excel worksheet on Pfizer. And I'm just going to introduce the groups of ratios that we'll be looking at, and then I'm going to do 4 videos, one for each group coming in. Okay, so let's go to the videotape, as they say. Do the slideshow here, and financial statement analysis. Basic method for analyzing financial statements to compute ratios in general. Ratios measure aspects of financial position and performance. Okay, here's what they measure. One group of ratios, there's about 13 basic ratios, and they're separated into 4 groups. One group measures liquidity, which is a measure of a company's ability to pay its short-term debt. One group measures ratio, which measures a company's ability to pay its long-term debt. I should put there to pay its long-term debt, most notably bonds. Shareholder ratios measure how a company is benefiting its shareholders, both in terms of stock price and dividends. So is the company getting your stock price to go up? I pay you some dividends. Okay, and accounting return ratios measure the company's or a company's returns to investors as measured by the company's financial statements. By that I mean they're accounting-based ratios. And the problem with accounting is that there's a lot of subjectivity in accounting numbers. And that subjectivity passes over to those accounting ratios. But they do form good general measures of a company's efficiency and profitability. Okay, in this video, I'm going to do liquidity ratios, and then I'm going to do leverage ratios in another video, and shareholder ratios, and finally accounting return ratios. And we'll use Pfizer as our example. Liquidity ratios, there's 4 liquidity ratios. The first one is the current ratio. Okay, and this ratio, the equation for this ratio is current assets over current liabilities. Okay, think about what a current asset is. Current assets are assets that are cash or that will be converted to cash if you're being generous within a year. And current liabilities you're going to pay off within a year. So you want this ratio to be as high as possible. And let's go ahead and what I'm going to do is I'm going to go over here. I'm going to do these on an individual basis. I'm going to go over here to the Pfizer worksheet. And here is the Pfizer worksheet that we're going to be building. And your current ratio is your current assets divided by current liabilities here. So these both come from the balance sheet. Okay, so your current assets are going to be your total current assets. We'll just do these. We're going to do these for the latest year, 2019, which is on this particular one. Your total current assets are $32,000. Your total current liabilities are right down here, $37,000. Okay, so this means that for every dollar of current liabilities, you have 87 or 88 cents of current assets to pay these off. The higher this ratio, the better, because that makes you more liquid, and you usually want it to be greater than 1. Okay, would this be a time something to panic about because it's under $1? No, not for a company this size. Okay, next ratio. Back to the PowerPoint here. Next ratio is the current ratio. Next ratio is the quick ratio. And now this ratio is a version of the current ratio. Notice both this ratio and the current ratio have denominators which are current liabilities. So that you're measuring your ability to cover current liabilities. Now this ratio, rather than using all your current assets, what you're using is what are called quick assets, or just some of your current assets, and more specifically, the most liquid of your current assets, which is cash plus accounts receivable plus marketable securities. So you're assuming that you're only going to use your most liquid assets to pay your current liabilities. Okay, and if you read the bottom there, it says this ratio measures whether the company has enough sufficient cash or near cash assets, referred to as quick assets, to cover its current liabilities. This ratio is similar to the current ratio, but only includes cash and the most liquid assets. It excludes inventory, which is not sufficiently liquid, and prepaid expenses, which you cannot use to pay off debt anyway. Okay, so let's go back to the sheet here, and we see that the ratio is cash plus accounts receivable plus marketable securities. So how would this look like on Pfizer's balance sheet? Okay, first of all, we have quick assets, and I put the quick assets out here. Quick assets are cash plus marketable securities plus accounts receivable, and that's going to total up to 18,554. Now, the denominator is the same as for the current ratio because both ratios measure your ability to cover current liabilities, but we're only going to use 3 assets, current assets in the case of the current ratio, your cash plus marketable securities, which are short-term investments, plus your accounts receivable, which gives you a ratio, an amount of 18,554, and there's your current liability. So that means that you have about 50 cents in really, really liquid assets to pay off your current liabilities. Notice that there's a huge difference here, which means you have probably large inventories, some other ratios, and some prepaid expenses, which you excluded. But there's a big drop here. So you look at this, I'd still say Pfizer's a big company. You're not going to have, it's not going to be very, you're not going to panic over this. Um, and you'll see in the leverage ratios, they have plenty of cash flow. So it's, for if it were another company or less well-known company, these under one ratios want both to be higher, because you're going to be able to pay off your debt, but it's no reason to panic for a company like Pfizer. Okay, your next ratio is, let's go back to the PowerPoint, and your next ratio is going to be the accounts receivable turnover. Accounts receivable turnover, the equation for accounts receivable turnover is credit sales divided by average accounts receivable. Okay, now keep in mind it says whenever you have an average in any of these ratios, average accounts receivable, inventory, assets, whatever, what you're going to do is you're going to take the beginning balance plus the ending balance and divide by 2. So our denominator in this case is going to be beginning accounts receivable plus any accounts receivable divided by 2, divided into credit sales. And what does this ratio measure? The ratio measures how many times a company has collected its average accounts receivable during the period. The higher, the faster, the better. You want this ratio to be as high as possible. Okay, and it's we're gonna label it times because you're gonna collect your receivables balance 2 times, 3 times, 4 times, 5 times. So let's go back to the Excel worksheet here, and here's our accounts receivable turnover, credit sales. Now, it's theoretically it should be credit sales because we're measuring how many times you could collect sales that have gone through accounts receivable, which are credit sales. But companies, because some of them, sometimes it's nearly impossible to separate your cash sales from your credit sales, it's become a habit just to use total sales here, which is 51,750 here. Okay, and now your average accounts receivable. Your average accounts receivable, like I said, when you have an average, is you're going to take your beginning accounts receivable plus your ending accounts receivable and take the average of those, which is 2. We're going to divide that by 2. Okay, so your accounts receivable turnover here is going to be 6 times. So that means that you collected your accounts receivable balance 6 times, 6.18 times during the year, which is good. The more you collect that, the more times you collect that, the better. You want to collect receivables as fast as possible to get cash in the bank. Now, another way to express this is what we call days collection, which is the number of days that it takes, that given a certain number of times of accounts receivable turnover, we ask ourselves, how many days does it take to collect your average receivable balance? Well, we just take the 365 days in a year and divide by your accounts receivable turnover. So it's 365 divided by the accounts receivable turnover that we just picked up there. It means that you're collecting your accounts receivable every month, so every 60 days. You want that to be lower. You'd rather be collecting it every 30 days or every 10 days, but that's maybe an industry thing. So you want this number, the accounts receivable turnover, to be as high as possible, that number right there. And if you take that into the number of days, you want the number of days it takes you to collect accounts receivable to be as low as possible. In this case, they're collecting the receivables on average every 2 months. The final liquidity ratio, we will go back to the PowerPoint here. The final liquidity ratio is your inventory turnover. Your inventory turnover is very similar to your accounts receivable turnover. However, your inventory turnover is measures the number of times that you sell your average inventory balance during the year. This, by the way, I should change this right now. This should be inventory turnover. I'll just say IT, inventory turnover. and I'll put here IT2, replace that with, that should be inventory turnover. Okay, and it measures how many times the company has sold its average inventory during the year. Okay, and so you want to sell your inventory. If your inventory, if you don't sell your inventory, you're out of business. So you want to sell it as fast as possible. Okay, so it's basically cost of goods sold divided by your average inventory balance. Okay, so let's go back here to the Excel worksheet. And for Pfizer, you get your cost of goods sold. Your cost of goods sold comes from your income statement. So your cost of goods sold is right there. For Pfizer, your 10,219. Got to go back. I guess I missed the equal sign there. So it's equal to 10,219. Your average inventory is equal to, we'll go to the balance sheet. Your average inventory is your beginning inventory plus your ending inventory divided by 2. Give you about 8,300. Okay, so wrong number there. Let's just do this. That's 8,300. I want to make sure I'm getting the right line here. Excuse me for my mistake here. But let's make sure we get this right here. You go to the ratios, and your average inventory is going to be your beginning inventory, 7,500, plus your ending inventory, 8,283, divided by 2, gives you about 78,995. Okay, so you turn your inventory over not too many times this year, about 1.29 times, which is almost the entire year. Divide by 365, divide by that means it took you to sell inventory 282. I don't know if that means anything for a company like Pfizer. The pharmaceutical industry, you really have to compare it to other companies. And you could also take a closer look at how you're calculating this ratio. This is the conventional way. Maybe there's a special way in the pharmaceutical industry. I don't know. But so they have high inventory. They have a very low inventory turnover ratio, and it takes them, which means that it takes them a long time, many days to sell it. Could be because something went off patent. When a drug goes off patent, if competition comes in, and they have to lower the prices just to get the stuff out the door. Anyway, I'll post these ratios, and we will continue with this later. Okay.